Okay, everyone, thank you very much for your time and for registering for XILVA's webinar. Today, our theme or topic today is about long-term financing models for nature-based projects. And we have Tim, a CEO of XILVA, as the moderator. And we have very beautiful panelists today, Megan and Natalie. And I'll let Tim introduce them.
I like it how you introduced the other panelists as beautiful and not me, but that's fine. It's all good. So thank you all for attending and for joining. This is a very interesting topic to many people, among them to us. So I will do a very short introduction of myself and of XILVA. I'm Tim, I'm the CEO of XILVA. We provide due diligence on nature projects, mainly in the forest space, on behalf of investors. So we work only for investors, among them, for example, Symbiosis Coalition. With them, this idea came up that there is actually a lot of market interest also in different models, not just in the Symbiosis Coalition model, but in other models. And that's what brought us to set up this webinar. Quick introduction on the panelists, and I have to look at my notes here because the CVs are quite impressive, actually. So we have Natalie, who is the Origination and Partnerships Director of Symbiosis Coalition. She has a background as an environmental engineer and also an MBA from Stanford. She worked in private equity at a bank and also at an investor. Also ran the Stanford Graduate School of Business Impact Fund. Worked in origination and carbon project development at Pachama, and now is with Symbiosis Coalition. She's also a sports coach, so if you want to learn about cycling or skiing, then she can help you with that as well. Second panelist is Megan, and she is head of the Carbon Nature Fund at Climate Asset Management. Climate Asset Management is a joint venture of HSBC and Pollination, and the Carbon Nature Fund is a vehicle for Apple and its suppliers. She studied at Yale and Harvard. She worked in energy and energy finance, both at a project developers in banks, always in the real asset environment, and in all sides of the capital stack, basically. Other infrastructure and sustainability topics she covers were water, carbon, also very early on in blue carbon, for example, has been in that space for quite a while. She joined CAM shortly after its creation, initially as investment manager. Besides her work there as running the Carbon Nature Fund, she's also on the board of multiple nonprofits, such as she's a national council member of the WWF. She's also a board member of the Mexican Nature Conservation Fund. And on the side, if there is even more on the side, she also ran a startup for ethical fashion accessories. Welcome, the two of you. And I would suggest that we actually start with both of you introducing the models you're working on right now. How do these models work? How do they benefit projects? What advantages, also what risks do they provide? How does Symbiosis Coalition, if we start with Natalie, how does your model work?
Perfect. Thanks, Tim. So Symbiosis Coalition is an advanced market commitment, or AMC, from 5 large corporates: Microsoft, Meta, Google, Salesforce, and McKinsey. And we were launched roughly a little less than a year ago with the goal of catalyzing the supply of high-quality nature-based carbon removal. As a group, we made a commitment to offtake 20 million tons, or sign offtake for 20 million tons by 2030, and are now in the midst of running our first RFP to actually go source those projects and identify a first batch for contracting. And the goal or the focus for us is really on the removal side of things, carbon removal side of nature-based, starting with reforestation and agroforestry, because of the sort of unique financing challenges that this subsegment of the market faces. And I think many of you who may work in reforestation know that the project economic profile it can be quite challenging, with first credits coming, in year 5 or sometimes even later, really long payback periods, both of which make the risk profile for an investor particularly tricky. And so as a result, a lot of these projects have struggled to access financing, and it tends to be very expensive if it is available at all. And so the theory of change of Symbiosis is first sort of at a macro level to send a big headline demand signal to say, like, hey, these corporates are interested in nature-based carbon removal done right and at a high enough quality bar. We also published a set of quality criteria to sort of show the market what good looks like and what we're looking for and what we're willing to buy if it is available on the market. And you guys can see that the quality criteria are published on the website if anyone's curious. And the goal here is really to start to get more developers and investors building projects with that large demand signal, and kind of help the world get the carbon removal it needs to meet climate and biodiversity goals. And then second, at a sort of micro or project level, we are actually signing long-term offtake agreements. We are committing contractually to pay for carbon removal tons at a time in the future. And the goal of signing these agreements is to allow developers to go to an investor and get financing that they otherwise wouldn't have been able to access, or to get that financing at a much lower cost of capital because the offtake piece of the equation has been de-risked. A key part of this is that we're a group of kind of credit-worthy buyers, very, large corporates with strong balance sheets. And so there's a lot of certainty around the offtake being there, 10 plus years in the future, which, as we know, is when the payback starts to happen for these projects. Our hope is that these projects will be, they'll not only help these particular projects get financing, but then serve as case studies for this model and sort of trying to get other investors and other developers and certainly more buyers as well into this market and helping the market scale up. This model may sound familiar if you've spent time in other areas of infrastructure and project finance. This is really common. It's, is used maybe most commonly known in the renewable space with power purchase agreements or PPAs as a way to, use a corporate commitment or offtake agreement to get financing in. I personally think it's even more essential in the carbon market than maybe any of the other areas of project finance and infrastructure that at least I've worked in, because the market is so uncertain and the demand for the end product has been quite variable. Pricing is all over the place and the whole market is voluntary. And so therefore the offtake piece is sort of even more critical than it would be in other areas of project finance. So that's our model. Happy to dig into it a bit more. And I think I will pass it over to Megan.
Yeah, and just if I may interject very quickly, so we have a chat open. So if you have questions to the participants, to the panelists, feel free to put them in the chat and we will collect them and then ask them at the end and have enough time reserved for that. So, and with that, I hand over to Megan. Thank you.
Great. No, thank you so much for having me. And it's always fun to do events with Natalie, who I think is really driving the market forward and articulated very well what this market needs. I am with Climate Asset Management and speaking on behalf of CAM today, not on behalf of any of our investors. We, as you mentioned, Tim, were created about 5 years ago. We're a joint venture financial asset manager. We manage products that invest only in nature. That's all that we do. And we've raised just over $1 billion in 3 different financial products that appeal to different investor bases. All of them are 15-year funds, and all of them invest directly in projects. So we do not invest in companies. We don't invest in funds. We are interested in providing project finance directly to projects in ways that generate value for our investors, for climate, for community, for nature. And all of our vehicles are Article 9 funds under the US FDR, for those who are familiar with that. Of those vehicles, we can invest in carbon in different ways. So we have a vehicle that's a more typical real assets vehicle that does primarily agriculture, forestry, and other land use change in developed markets, where we typically will control land. And any carbon generated out of that vehicle is monetized as part of the overall return to our investors, who are typically institutional investors like insurance companies and pension funds. We also have vehicles that invest for carbon. So that's dollars in, credits out. And that's really a pooled procurement vehicle for corporates who are looking for carbon credits that meet their needs. We designed this product because we found that corporates are looking for visibility on the quality, the volume, and the price of the carbon that they're receiving, particularly as carbon becomes a more expensive piece of the equation. And you see that in the corporates, like some of Natalie's members, who are willing to do upfront finance for a long period of time, which is really unusual for corporate treasuries. But they're doing that because they need to, because this is a product they can't get on their terms otherwise. Our investors are also looking for institutional management. This is a market that was $300 million in 2020. It's been created by NGOs, I think somewhat heroically, but it is not one that has had the capital available to do the institutional quality diligence and anti-money laundering tracking and all the other things that come with a financial asset manager like us, who's regulated by the FCA. And the real active management and specialist management we have, where we can help to identify, anticipate, and mitigate challenges alongside our partners. They're looking for a diversified portfolio. So even some of our large investors who could write a very large check and do their own project are interested in diversifying their risk across geographies, partners, project activities, methodologies, all the different risks that exist in this space. And they're often looking to be in a club. It's nice to invest alongside others in a market that's just developing like this. I think that's probably some of the impetus behind Symbiosis as well. And then finally, we find a lot of our investors are, I would say I hear from chief sustainability officers that they want to be a hero to the CFO. So they're looking for a way to convert carbon credits from an increasingly large expense to something that looks more like an asset. And how we do that is our funds invest upfront and receive carbon in kind. That carbon credit is an asset until someone chooses to retire it, which is the primary purpose of these vehicles and of the corporates that invest in them. But that gives you the opportunity to invest in something as an asset, which means you hold it on your balance sheet differently, and it can be come out of a different pot of capital often, which can help corporates meet their goals. In terms of what developers are looking for out of these types of vehicles, we find they're looking for funding for projects, obviously. Very difficult if you're a developer, maybe raising Series B financing for yourself to try to figure out how to fund all your projects. Particularly if they involve land acquisition, but often developers will come to us with 4 years of stakeholder engagement activities. They've funded feasibility studies. They've put technical consultants on the ground, right? It's a huge amount of work. And they've proven something and they really want to scale it up, and scaling it up costs, takes capital they don't necessarily have and they don't want to fund on their balance sheet. And that's exactly what project finance is meant to do. That's what I've done my whole life in the renewable space. And that's what we're applying here. Typically, developers also want an aligned investor. So they want somebody who can contribute something other than capital, who they understand is aligned in their best interest and the best interest of the corporates who'll be buying these credits. And they often want visibility on where those credits are going. So the nice thing about our vehicles is, our buyers are our LPs. So that means when you partner with us, you know where the credits are going, and the primary purpose of credit generation is retirement. You won't necessarily see your credits being traded by a trading house 15 times in the future and generating headlines. And who you're signing up for. I would say the way we structure projects is to take project risk alongside developers. So we're putting in project funding generally at cost. So it should be seen very differently from a payment on delivery contract for de-risked credits, because those are just two very different things. So in terms of your question about what risks we take, all of them, we take all of them alongside developers. But what we take off the table is the financing risk. We're really interested in getting developers off this flywheel of a situation where they have to finance a project and sell it in order to get the money to do the next project. We want to give them the visibility, and we don't want them to spend all their time fundraising, because that's not in our interest either. So we take the financing risk off the table typically because we're looking to write reasonably large checks and want visibility on project delivery. But I think in general, we certainly take all the risks alongside. And then finally, I just wanted to point out in this, so we have a vehicle, as I mentioned, that monetizes carbon. So there was an announcement last week of an investment that we made out of that vehicle in partnership with Meta. Meta is the off-taker. That's public information. So that's a really good example of the kind of thing that we can do that's perfectly aligned, I think, with Symbiosis, just to give people context. And but then separately, in our carbon credit vehicles that deliver carbon in kind, we can also coexist alongside market sales of carbon. So we can often, for example, fund all of the project costs required to get the project off the ground, and then the project can sell de-risk credits to the market for an additional profit or exposure or benefits to partners. So those two can coexist, which I wanted to highlight as well.
Great. So we had one question in the chat, actually, whether the recording will be made available. Yes, it will be made available. So that's answering that. And maybe one additional question to maybe more Natalie. we often see a phenomenon we call the valley of death between very early financing that's often available through philanthropy, through small-scale accelerators, where you can get the first check written to your project to basically create something like a pre-feasibility study or so. But then there is a relatively long gap between that time and then the actual receipt of first carbon credits or issuance of first carbon credits that you can sell in the market. I know that your model is built to address that valley of death partially, but are there other models that are specifically helping in that phase, earlier phase, right after feasibility study? Are there any other models you see in the market, not from Symbiosis, but from others maybe?
Yeah, I think there's a number of models and they have some overlaps. And so I usually think of them in sort of three groups that have some overlap and maybe some subcategories. I think the first is a corporate stepping in to finance that work post-feasibility study, but pre-issuance. And that can sort of come in different structures and flavors, but I typically group them into either sort of an investment where the corporate is putting in some sort of equity where they are riding the ups and downs and taking the delivery risk alongside the developer. It can also come in the form of a prepayment where a corporate is coming in and saying, we're going to pay you, X dollars for X tons in the future. There's probably some guarantees you need to make around those credits in the future. And so it's still capital up front, but it's maybe not riding the risk in the same way. Then another model that I've seen is the carbon streaming model. And so these are investors that are willing to put in money up front for sort of the rights to future credits or even the rights to buy future credits at a discount. These are often more like brokers or traders, and they are there to sell the credits in the future to somebody else and gain a delta on the sort of the spread there. Examples of that would be like a Rubicon or carbon streaming. I think this model has had potentially some challenges recently, but I think there's some that are finding success with it as well. So another one to keep an eye out for. And then I think the one that Megan and I are sort of both speaking to and think is really starting to take off is this more project finance model where you have an outside investor financing the project activities that is there for a pure financial return. And then you have an off-taker there that is there to take delivery of the credits and pay for them at the time of delivery and provide sort of cash flow certainty to the project. And examples of that would be the Meta and Cam deal that Megan just mentioned. Microsoft recently announced a deal with Climate Impact Partners and Terra Natural Capital that was similar. And I think what's interesting to highlight here is that you need to see all three pieces sort of coming together either at the same time or close to at the same time, because the off-taker wants certainty of financing and the financing provider wants certainty of the off-take being there. And so it's really tricky to bring those pieces together concurrently and at the same time to get to a close. But I think it's the fact that these deals are being announced as a developer, an off-taker, and an investor all at once just shows that you really do need all three pieces to come together to make that financing model work.
You have a project as well, right? So if you just have a rough pre-feasibility study.
Yes, and the project, exactly.
I mean, what would you advise somebody who has that rough pre-feasibility study, has maybe run a small pilot on 100 hectares, but doesn't have too much experience on the carbon side? What would you recommend them to do? What should they do?
Yeah, I think there's a few things. I think one is if you can engage with what we look at a lot in assessing sort of these earlier stage but still post-feasibility projects is partnerships or engagements with folks that have either done the carbon piece before. So maybe you're working with an advisor that is written a bunch of PDDs and knows the methodology really well. If you're stronger on the carbon side, but maybe not as strong on implementation, are you working with a local NGO that knows the communities and has done, many cycles of reforestation in that particular region? And so I think partnerships can be a really good way, especially because there's two pieces, right? There's the carbon side and then there's the restoration piece. And not all developers are going to be super strong across both. And so I think we've seen really successful proposals and projects where there's a partnership between the two to sort of bring these two really critical pieces together.
Okay. Megan, you want to add anything
Very well said. And I would just add, almost all of our projects have a project proponent, a project developer, and then a local implementation partner. That's the language we use, which is typically exactly as Natalie explained. There's someone who brings the technical carbon expertise, who's able to get Vera to call them back, which is incredibly important, and understand the expected changes in methodologies that may be coming, understand the remote sensing technologies, whatever else is required to develop the carbon. And then the local implementation partner, who is trusted by the partners on the ground, who has a track record of delivering restoration, and who has the capacity to mobilize and deliver on the ground. Those two together, we find, are partnerships that deliver success. In some cases, you'll find both in one. We also do see projects that have commercial revenue streams. So that could be timber, it could be agroforestry, they could be fiber for a corporate purpose. There are a variety of those types of projects as well. But even there, we'll often find that they need to bring on a carbon developer to enhance their carbon expertise, whether in-house or in partnership.
Yeah, there were a couple of questions in the chat about ticket sizes. So what is the typical minimum ticket size or typical ticket size of an investment that would be done under both of your models? I know Symbiosis one is still emerging, but maybe a rough idea. And Megan, you probably have some sort of idea what a typical ticket size would be or should be.
Yeah, so we aren't making investments ourselves, but we do want to see projects that have potential to get to a significant scale, because at the end of the day, what we care about is climate impact and nature restoration impact. And so we want to, and our buyers are large and have quite large footprints. And so we do want to see some path to scale. We don't have sort of a firm minimum, but we are prioritizing or looking for projects that can generate at least 500,000 tons of removal over the next 10 years for now. And we may explore paths for smaller projects and larger as well in the future, but that's sort of our initial indication of what we're looking for. And then again, really seeing that path to go even bigger is really important. So what would it look like to take your project and scale it over the next 5 to 10 years? And what does that look like in terms of carbon removal?
So that would mean 500,000 tons over 10 years, so 50,000 tons a year if it's a yearly.
If it was linear, which we know it is not, yes.
Okay, so that gives an indication of scale. Megan, on your side, what is the typical ticket size you're looking for with CAM?
Yep. And again, I think getting back to this institutional quality diligence question, and apologies for my lighting. I'm somewhere that it started pouring. So I lost all my daylight and I realize I look a bit like I'm underwater. So hopefully that's
very well. All good.
Consistent with the nature theme.
Room does its magic. All good.
Yes, fair enough. So in terms of minimum size, I mean, getting back to the institutional quality diligence point, it is expensive to diligence these projects. We have lawyers, technical consultants. We typically expect there to be a special purpose vehicle, which is sort of best in class in terms of project finance and controlled accounts and things like that, to allow us to track the capital. So all of that does come with some transaction costs. So we generally find that investments below about $20 million are difficult to justify in terms of the burden of the transaction costs on the returns, whether those returns are generated as a result of financial returns or carbon credits. And that's just a rule of thumb. It's not a commitment. There may be reasons why it makes sense to do something smaller as well, particularly if there's potential for scale or we're trying to prove something out that we feel has a real opportunity, to Natalie's point. So I would say that's generally the case. And again, that's capital deployed during the life of the project. So that's not a check that goes out the door on day one, particularly if we're funding an afforestation project that could be done in 7 or 8 years, right? That's funding that's going to go out during that period as that funding is required. So it doesn't mean that you need to be ready to absorb that on day one. And typically projects are not, to be honest, just because of the scale of this industry to date, people aren't fully ready for that. And it wouldn't make sense to deploy it. So we typically work very much starting from the project's needs, the developer's capacity needs, and then fund as required to meet those.
Yeah, very good. We also have a couple of questions on country coverage. So, I mean, I've seen that last week that year was US. I've seen a lot of deals also outside of the US or in very diverse group of countries. There was a question here on fragile states in Africa, for example. Somalia was mentioned. What is your take on that? What is the sort of country risk investors are willing to take, or just country coverage that you can typically provide?
You want me to start, Megan? I can start. So we don't have a firm constraint on countries. We're looking at projects all over the world. The only constraint we do have is that we can't work in US State Department level 4 countries, because we don't have any way to get sort of eyes on the ground and do a site visit, which we need to do for every project that we would offtake from. That being said, country risk is one of the big risk dimensions that we look at. And so we are willing to take risks in certain dimensions, but maybe not all dimensions at once. And so I think what is potentially more challenging would be a newer project developer with less experience and building out a new model that is untested, and you're in a risky country. So I think if we are in a riskier country, what we want to see is all the other elements are as de-risked as possible. And so the developer is quite experienced. Maybe they're working with local NGOs that have been in the region for a long time, other things that can de-risk some of the country risk. So that's not a straight answer on exactly which countries will be. It will be case by case, but it is certainly one of the big buckets of risk that we're looking at as we kind of seek to de-risk our investments or our
And then it would be pilot area already done.
Yes, it would need to be later stage. Exactly.
Yeah. Okay. Very good. Hope that helps. And then I had.
Sorry, Tim. I had my hotel Wi-Fi issue, so I think I heard the beginning of the question and apologize that I didn't answer it quickly. But just on the country.
Yeah.
On the country front, so as I mentioned, our real assets vehicle, which is the one that did the financing in the US, does have restricted geographies. It's a specific set of geographies. It's mostly US, Canada, Europe, Australia, New Zealand. That's for the existing vehicle, and that could always change for future vehicles. And then for the carbon vehicles, it's typically global with a focus on the global south and tropical belts where things grow quickly. I did see a question about project activities. So we have funds that are able to invest in conservation as well as in restoration. So it's not just limited to afforestation projects or to removals. And we will typically, I think, as aligned with Natalie, we need to be able to do site visits. We need our travel insurance to cover us, things like that. So there are restrictions on that front. And otherwise, we evaluate risk collectively, exactly as Natalie said, in terms of how likely we think this project is to endure and to have permanence, and what's within our power to help mitigate in terms of a risk.
Yeah, very good. Thank you. And we have a question also on biodiversity. How can biodiversity projects be financed? Biodiversity as a business model, elusive biodiversity credits. I'm already indicating an answer here, but how do you see biodiversity as what role should biodiversity play in the projects that you look at? And can it be a separate revenue line? How do you see that? One side is how to finance biodiversity, and the other is how to monetize biodiversity. Maybe that's a two-part question, actually. Yeah.
So we see biodiversity as one of the 5 quality pillars that we're looking at for carbon projects, because our corporate buyers are sort of focused on carbon as part of their net zero goals. That is the main revenue stream that we're focused on right now. I don't want to speculate as to whether biodiversity credits will take off in the future or not, but I think we think of it as a very core tenet of the work that we're doing, and one of the key areas that we're diligencing in any carbon project that we're doing.
Megan, any different views on your side?
Yeah, in our natural capital vehicle, the one that's seeking financial returns, we've looked at mitigation banking, which is, for example, the US mitigation banking market, oldest and largest biodiversity market in the world that no one's ever heard of. It is an offset market, which people have some feelings about, which I certainly understand. But there are other markets that, have emerged as well: Australia, UK, Colombia. So we've looked at opportunities there. We have not yet found one to invest in. But it is, certainly regulated compliance markets have a different risk profile than the voluntary biodiversity credit market, where I'd say we haven't yet seen a level of demand that would justify an investment unless we had an offtake. So it's back to the sort of chicken or egg point. But we actively seek to invest in biodiversity restoration in our projects. And in one case in particular, we have a project in Australia. We are primarily converting sugarcane land to a macadamia orchard, and we're also doing a wildlife nature restoration area on part of that property and seeking to fund that through a carbon sale. So again, not in a way where we're actively seeking to generate returns based on biodiversity, but we're seeking to leverage existing ecosystem services markets to be able to manage the land in a way that we think is best for nature. So that's one example of how we try to incorporate it. And we do have at least minimum biodiversity requirements in all the projects that we do. We have a level of commitment that I would say goes above sort of IFC Performance Standard 6 in terms of native ecosystem conversion and things like that. So it layers on top of the requirements of any type of carbon or international standard to meet the expectations of our investors.
Very good, very good. One question on first loss capital, like a model that's been established where you have a DFI, for example, come in with first loss capital, and then with the idea of that de-risking investments for commercial investors. Is that something that you actually see very concretely in your investment activities? Or is that something like a different world where you have the DFIs doing their thing and the private and the voluntary carbon market, private investors, voluntary carbon market doing their different thing?
I hear this talked about a lot, and I don't see it happen frequently. I'm curious if Megan has seen more examples of this, but I think the development banks are these sort of elusive, solution that a lot of folks are looking to provide that first loss capital, and I haven't seen them come in and play that role, at least not sort of in a meaningful way at this point.
I would say the same. I mean, your parallel is very good, Tim, for power as well. That's a way that other infrastructure assets have been financed or gotten off the ground. There's some examples. There's a World Bank outcomes bond that they did with Mombach that I know they're actively looking at doing more of, and that's a little bit more of a complex bespoke product as opposed to really first loss capital. But they are taking some risk and guaranteeing some return. So I think it has some of the same features. We see DFIs investing in carbon projects. So we've seen that directly. And that may also be for carbon for their own purposes. So, a little bit different, but aligned, and they can invest alongside other investors. We see interest from DFIs in financing against offtakes. So again, another role that, Symbiosis Coalition is playing by providing that offtake. We have active interest from DFIs who've come to us and said they'd really like to finance against those types of offtakes. So they're then a de-risking mechanism, but the DFIs are, potentially willing to go into different countries. Then you would have a commercial investor investing in against those offtakes, and they can sometimes be a really good aligned partner. Where I personally have seen the most tangible impact is USAID financing feasibility studies in the carbon space. I think they really saw that, and I say that in the past tense, unfortunately on purpose. They saw it as a way to get these projects off the ground, and we had projects that came to us, this was a wonderful example, right? If they partnered with someone who really wanted to do this kind of project, had the right kind of resources, but was at an early stage and needed help to get to the next one. And so they would finance the feasibility study to get it off the ground. And then they also had the connections to investors, including the corporates that we work with, to then put that on our radar, or the corporate's radar. And so I very much hope we see others taking up the mantle.
I mean, what we see with DFIs is that their due diligence requirements are very thorough, probably even more thorough than what you have as an asset manager, as an institutional asset manager. So maybe they're just still in the process. That could be, that would be an optimistic view of the world.
We find we ask more, I'm sorry to say. Having looked at a couple projects that have gone through sort of DFC or IFC performance standard alignment, we do ask for more. But we think we're faster. So there's that. But yes, I think the thorough diligence is honestly really helpful as well, because if we find a project that's already gone through that process, they can handle, folks can handle, they have the information available and they can sort of engage with us in a way that's quite helpful. So we find there's a lot of alignment there.
Yeah, that's the speed thing is definitely a topic for also reasons. I mean, we ask as taxpayers for them to be very, very diligent and follow processes that are that are different than we as investors ask of commercial asset managers we trust our money with, right? Everybody does their thing, and I think it's everybody that does the best they can under the circumstances that they're in. So that's my take on that. We have a question here from Sherry, who I met last week. Hello, Sherry. There is a question of equity versus offtake versus SPV investments. Can you maybe comment a bit on that? What's the is it you said already, Megan, that you're doing only SPV, or as a best practice you do SPV, special purpose vehicles, and what is the environment you see there, maybe from others as well, and yeah, maybe you can comment a bit on that.
Sure. Hi, Sherry. Nice to see you, although I can't see you. We see financing structures. So we do long-term finance. So typically, as I mentioned, the vehicles are 15 years long. We see all of the above. So we have invested in SPVs that we own, that look much more like a typical project finance, project equity, real assets type approach. We sign contracts with SPVs that counterparties own, where there's still a fair amount of control over use of capital. There's a lot of transparency. And we also sign contracts directly, where that makes sense. So it's really depends on the case of the investment and where we see the risks, and how best to structure mitigating them. But it is important to us that we have a fair amount of visibility over how proceeds are used for reasons you can imagine, and that those proceeds are segregated from others. And we also, just to be clear, we can do things that look like equity. We can do things that look like debt, in both vehicles, whether we're seeking a return or whether we're seeking carbon credits. And we can look, most of what we do is upfront finance, just because that's what we were designed to do, to fund high capital expenditure for land use change upfront. But we can also have an element of payment on delivery, if that makes sense, in one of our vehicles, or do other things. But typically what we're seeking to do is provide upfront finance. That's where we see that we add value in the market.
I can just add that I think, in thinking about equity versus debt as the main financing instrument in this market, what I've seen so far is that it is mostly equity investors that are interested and active in following on to invest on the back of these offtake agreements. But over time, our hope is that more debt investors will come up in alongside equity investors. And often when debt investors are there, it is alongside an equity investor, because it is still perceived as pretty risky for just standalone debt to invest in these projects, especially in a first-time project developer using a new methodology and some of the other risks that we've mentioned. But certainly our theory of change and our hope is that as the risk, developers get more of a track record and risk sort of comes down in various ways in the market, there will be a lot more debt, which is a lot lower cost. And so that will mean more, potentially more proceeds going to project stakeholders on the ground, potentially lower costs per ton for corporates, and sort of a more efficient financing model to scale the market over the long term.
I just want to add, we've seen a couple evidences now of more like plain vanilla project debt. Typically in the US, typically with an off-taker that, of the quality that Symbiosis is working with. But we're seeing more of that, which I think is incredibly exciting. Maybe 6 or 7 years, maybe a little longer, maybe a little shorter. So it's not necessarily like the very structured project debt that exists in the power space. But I think it's really exciting to see that, because exactly to Natalie's point, that's evidence that also the commercial banks are starting to get that this is an asset class that makes sense. These are contracts that are valuable with high credit counterparties, and that the actual project activity is something you can understand to a point where you can underwrite that risk with a debt profile.
You mobilize totally different funding sources at a totally different scale and a totally different transaction cost and transaction effort required. So much easier, much cheaper also potentially to get. There are a couple of questions on. Basically, I try to paraphrase it. Natalie, you marked one. I said you wanted to answer it. What am I doing if I have a smaller project, right? I have a project, 500 hectares. It works really cool. It's in a great region that you can provide check all the boxes of the Symbiosis quality criteria, for example, but you just have 500 hectares, right? So you're never going to make the 50,000 tons a year. So what do you do if you have that kind of situation?
Yeah, I think there's a few pieces. I think first is just acknowledging that carbon projects have very high fixed costs. And so there is a scale below which a nature restoration project may be an amazing project for all of its benefits, but carbon finance may not be a great fit for it. And I don't know, people speculate at exactly what that number is. And I think it depends on how productive the region are and what your implementation costs are, et cetera. But I think there is a threshold at which it's just really hard to make a carbon project work. And that's before you even get into the diligence piece of it, which is, I think, the fixed costs that Megan was talking about associated with the transaction. That's just kind of the project fixed costs. Assuming that there is scale beyond that few hundred hectares and you sort of think there is a path to that scale, I think we want to see evidence of that to get comfortable with signing a smaller offtake that can grow over time. And I imagine is similar as an investor to write that first check with visibility to it scaling over time. And I think the way to think about that is what is sort of the eligible land in the region that you're working. So first, from sort of a carbon feasibility standpoint, is there other land that is in a similar situation and could sort of similarly be reforested? And then there's who are the landowners and are they actually interested in starting to think through what that pipeline of landowners would look like? The farther along that is, the more comfortable we feel that there really is scale there. And then, of course, thinking about supply chain to scale up and sort of each of the elements that would need to be there. And I think the more evidence you can sort of present that there is an opportunity to scale up, the more interesting it becomes to us. But at a certain point, like there sort of has to be that path to scale for large off-takers like the group that we represent to be interested.
So the recommendation to Sergio and Caroline, for example, who asked this would be then find partners, essentially, right? I mean, find partners locally where you can scale the project locally, or in a group project with others, because the Verra fixed costs we're very aware of. That's I mean, not the amount of money you spend with Verra, but to set up a project that's certifiable by Verra, that's also to be taken into account, not just
exactly. Yeah, but it's a great point. I think that doesn't have to just be you. That can be, who else is working in this region? Are we doing a similar thing? Can we sort of create a grouped project, which, we see a lot of the projects that we're looking at that are large are generally not one contiguous area. They're generally taking a sort of landscape regional approach. And sometimes there are many partners involved in that effort.
Another question, I think that you marked, Natalie. Sorry, Megan, if you want to add to that or no. Another question that you marked from Mireille. Hi, Mireille. On carbon. So basically, I'm paraphrasing here, but if you ask the forest to deliver carbon and carbon only, if you do a carbon project, then the forest will deliver only carbon. And is that leading to the best outcomes, or shouldn't we ask the forest to do more for us than just deliver carbon? For example, biodiversity, social inclusion, livelihoods, etc.
Yep. So again, I'll point back to our sort of quality criteria. Carbon and carbon accounting is just one of our 5 pillars. Biodiversity and social and community benefit are 2 others. And so we really are looking at multiple of those. In terms of, I've been sort of bucketing all these projects as nature restoration projects, but really there's 3 kind of subcategories that we're looking at. One is what I would call kind of conservation-oriented nature restoration. That is restoring nature back to its original landscape. It's probably just carbon as the main revenue stream. There's obviously, we're looking at the ecological benefits very closely for those types of projects. We are also very interested in agroforestry projects and small-scale working forests where, it's not necessarily a commercial timber operation where the financing is maybe less additional from carbon, but there is an element of harvest or other wood product that is coming to support the local communities. And I think these projects are particularly interesting because there is the ecological benefit and nature restoration benefit, but there is benefits. There are other revenue streams which can really help from sort of an investment perspective and the long-term durability of the project. It de-risks it if there are multiple revenue streams. And then, our buyers care a lot about durability and will this carbon remain sequestered for as long as possible? And that's a lot more likely to happen if the people in the area are seeing some benefit from that forest or that restored area. So we are certainly looking at projects that are have revenue streams beyond carbon, and then also impact beyond carbon as we think about our quality criteria.
Yeah, I also encourage to read a recent article in Nature. We posted it, I think all of us posted it somehow, that showed that small-scale agroforestry in Southeast Asia was a study area that has actually a negative leakage effect. So it has positive effects beyond the area, which is usually we look for negative effects somewhere else, but it actually has positive effects somewhere else. So that is very, very encouraging, especially in the agroforestry. That's also something we see in our diligence work a lot, that if you have just a carbon revenue line, it's just a difficult situation for a project in many different dimensions, because it's hard to forecast, and also it doesn't necessarily, as a generalization, provide the livelihood benefits that you need to make the project permanent. That's what we see. Megan, anything from your side on that? Yeah.
No, I agree.
Question from Dominic, who we also know. Hi, sorry. He's asking how do you see sequestration? So, for example, ARR versus avoidance. So, RED, for example, is there a market? I mean, we've all experienced the RED Plus scandals, but how do you see the investor appetite for new projects right now? Is there any appetite on RED as well?
Shall I take that one, Natalie? Just since it is an eligible investment project activity for one of our funds. I do think there's interest. I think there's broad appreciation that it's not enough to just restore. We need also to protect what we have. And obviously, it's incredibly challenging in any carbon project to work against a counterfactual baseline that you, by definition, can never prove would have occurred if you hadn't done your project. So I think it's just an uncertainty that people understand. There's a lot of interest in JRED jurisdictional approaches. So we saw a lot of interest in the Para leaf project that was announced, I believe, at New York Climate Week. And there's absolutely interest. I think it's more to Natalie's earlier point, looking for landscape scale projects, looking for projects that you're confident have integrity, and where you're confident of the measurement, reporting and verification approach that will deliver value to you. And then I think you also need to think about reputational risk. That is a big part of this market. We have really fantastic investors who are doing this for all the right reasons and are putting voluntary dollars to work to really advance the market and demonstrate what these projects can do and deliver quality. Nonetheless, it's pretty much a guarantee that any project in this market will encounter some challenging press. And so we do see folks potentially participating in those types of projects without making it public, because either their PR department or they themselves don't think it's necessarily worth it at the moment. So I do think it is a bit of a concern for those types of projects that have encountered more challenges in the market. And that's one of the reasons why you see a shift towards more expensive removals projects that are easier to quantify. But I wouldn't say that's an evidence of no demand. I think it's a shift that's going on in the market that will play out over time.
Thank you. We had a couple of questions on other methods, other nature-based instruments or other nature-based activities, such as, for example, wetland restoration. I don't know if we had anything on biochar. Any opinions on those ones?
I'll answer briefly. I mean, in our natural capital vehicle, we can invest in land use change and land activity changes that generate value. So they could generate value through biochar, they could generate value through restoring wetlands, really any type of intervention that makes sense and is commercial. We do only nature, so we don't exist to finance what I would call big gray boxes, even though I used to do a lot of that in my previous life. It's just not our mandate. We can certainly do that if it's part of a broader project. So we could do a biochar facility as part of a land use change. For example, I saw a project, I think last year, that was harvesting an invasive species over a wide land area in partnership with an indigenous group and turning that into biochar for sale, right? That is the kind of thing I think we could do. We haven't done one of those yet. We also see agroforestry projects or agriculture projects that have a biochar component in them where we could potentially finance that activity. And then the biochar revenues are a source of revenue to the project that we don't necessarily benefit from because we aren't seeking biochar credits. In wetland restoration, we typically need some type of market. We can either do it as part of a larger project for which the revenues come from another source. So that's often the case in a forestry project, for example, of which wetland restoration can be a really important piece. Or if we were to do a standalone project, it would need some type of revenue stream. So where I've seen that to be most proven is the U.S. mitigation banking market under Section 404 of the Clean Water Act. But it could exist elsewhere if there's restoration funds available. There's a market that exists. So peatland restoration is something we're very actively looking at in the voluntary space as well.
Very cool. Very cool. Natalie, anything to add?
No, I think I mentioned at the beginning of the call, we're focused now on mangroves and forest restoration and agroforestry. The next project type we're looking at will be mangroves, and then we're going to consider other types beyond from there. The reason to not focus on Red Plus was not because it's not important. It certainly is, and I think many of our members, if not all of them, are a part of Leaf Coalition as well. And so the focus for us is really just where does this theory of change make the most sense and where is there a gap in the market today? And that's why we started with the focus that we have. But it's certainly possible that we'll expand the aperture in the coming years.
Very good. Last question from the audience, also posed by a couple of people: green bonds and outcome bonds, outcome-linked bonds. Is that something that you see, or is that a little bit in the elusive space as well?
Well, I think Megan mentioned the World Bank outcome bond with Momback that was announced last year. And I think this was a really innovative and interesting model. And from talking to various folks in the market, including other development banks, there is interest to do more deals like this. I think these deals require a very specific sort of risk profile. And if you take a look at the deal more closely, like you'll see that the offtake was in place and sort of at scale for someone like the World Bank to come in and be interested in this type of structure. So I think there's a lot of potential, but this is going to be for sort of later stage, more mature projects. But I think there's huge potential here to sort of bring in these more impact focused debt investors to this market. And it seems from my conversations that there is interest both at the development bank level, but then also from their LPs in doing more deals like this.
Very good. Then one question more, first part of the closing round. If you put yourself in an investor's shoes, which you're in actually, what should an investor, like another investor who's just thinking about getting into this, what should they do? What approach should they take in order to find high quality, high integrity projects to invest in or buy offtakes from? What's the sort of approach somebody who is maybe in asset management, maybe in real asset management, real estate, what approach should they take if they want to move into this market?
Finance against a Symbiosis offtake, right, Natalie? You guys have done all the work.
Do due diligence with XILVA and
do due diligence with XILVA,
mandate to Megan. No, sorry.
You do the due diligence with XILVA, then you work at the Symbiosis offtake. Natalie was talking about partnerships. That's where we are. Hopefully people could see. I mean, this market's pretty small. We tend to all know each other. And I think that's
a deal with Cam, right? Yeah.
Well, no, I mean, certainly consider one of our products. We're not actively marketing, and that's not something I'm doing right now on this webinar. But we do offer, a service to folks who want to put capital to work in this space, and whether they would like some exposure to carbon alongside more traditional conventional revenue streams like commodities from real assets, we can do that. I mean, I think or whether they're looking obviously for carbon as an off-taker, that's something we offer as well. I think my primary piece of advice would be this is a long-term market. These projects are long-term, particularly if you're looking for nature-based results. Anybody who gets into this market and thinks they can generate a quick return in 6 months, I mean, I'm sure there's some traders who've done very well, but I don't think it's a long-term strategy. And I find where we find the most challenges are people who come to this space and don't recognize that we are really subject to the laws of biology and physics. There's only so fast that a tree will grow. And if you've got a short-term time horizon for carbon and you want to do an afforestation project and you just do the math, it probably takes 4 years to do the stakeholder engagement and get that project ready to go, do the feasibility studies. Then you plant year 1, then you plant year 2. Depending on where you are, it takes trees a very long time to grow. In Scotland, it takes 15 years before they're eligible to issue a carbon credit, right? So you really need to think about this as a long-term game. And I think about what you're getting into and if your returns expectations are commensurate with what the asset class can provide, and the risks you need to take. So again, depending on geographies, you may be taking much higher country risk in order to get that high growth risk, growth profile that's important to meet the terms of your mandate. So think through all of those and then look for very high quality partners on the diligence side. It's a really difficult market to understand. There's a huge amount of acronyms. As we know, there's an alphabet soup in this space. The methodologies change every year. There's lots of questions about quality, and a lot of people just don't understand what it is, and that generates a lot of confusion. So I think align your partnerships, commit for the long term, align your partnerships with folks who've been doing this for a while, who can help you navigate those changes, and help you predict the future, because that's really a bit what's required to future-proof these investments.
Well, aside from joining a coalition, which I think is actually a model that many corporates have seen as a way to enter this market and get comfortable in sort of a group setting, with Frontier on the engineered side, Leaf with Red Plus, and then Symbiosis for nature-based removals. I think the other thing that is a shift as corporates think about signing a long-term offtake versus a spot purchase, which is where the market sort of has been, very similar to what Megan said. You have to think on a much longer time horizon, and you have to think not only about quality, how likely is the ton delivered to me in the future going to be sort of represent a ton and do all the things that it was supposed to, but how likely are you to actually receive that ton? And that is a different sort of mindset, and requires actually a very different set of diligence expertise. And I think this is actually where, off-takers in partnership with investors can really complement each other on the diligence side, because I think buyers are ultimately the arbiters of quality. They decide if they want to buy that ton or not. But the delivery piece means you need to look into counterparty risk and country risk and all of these other things that may be newer for a corporate to look at. And I think, investors are really well set up to diligence. So I think there's really promising sort of partnership there to each party kind of focus on the risk elements that they are most able to de-risk. And again, that long-term perspective is really critical.
We're at time. Just one 15-second, 30-second answer I want from both of you. What does success look like in 10 years? So what has happened if Symbiosis Coalition has been successful and you look back to it from 2035? What has Symbiosis Coalition achieved?
I think first and foremost, we'll see a lot more buyers in this market. We'll see sort of a whole slew of deals, a whole track record built up of precedent transactions from investors and off-takers, and real institutional knowledge at large on how to actually get these deals done. And then I think we would see sort of the traditional asset managers and infrastructure investors coming in and deploying billions of dollars with, many, many transactions happening every year.
Megan?
Amen. And I think I would add, nature restoration as an asset class for the largest investors and corporates. That's really what we're seeking to demonstrate, that it generates real commercial, tangible value. And to Natalie's point, that their precedents, there's a track record, the capital's being allocated in a rational and informed way to projects that perform and deliver, so that we can all see more of those.
Thank you very much. And thank you both for participating in the webinar. Thank you for the panelists, for the participants, for the great questions. There are many questions that we couldn't answer, many also that relate to project quality. What kind of things are, for example, Symbiosis and CAM looking for? I know for a fact that on the Symbiosis web that there is a lot of information, so I suggest you check that out, because it is very, very detailed on what you're actually looking for. CAM also has resources on the website. We have our diligence methodology roughly described, so I suggest you check out the resources on the website, and then also use the contact options on those websites if you need more information. With that, I would like to close it. Also thank Ling for working in the background on the moderation of the questions. And thank you all, and wish you a good late morning and early evening, depending on which side of the globe you're on. Thank you very much. Bye-bye.
Thank you.